Cool. Hey, Brad. It's good seeing you, man.
You
Thanks
too,
for doing.
John.
I appreciate you giving us your time and providing some insight on kind of some of these financial questions that a lot of people have, especially kind of with everything going on right now. I know the coronavirus scare has kind of led a lot of buyers kind of in question on what financing looks like nowadays. I know restrictions are out there now, some lending programs, etc. So yeah, I'd love to maybe start with kind of give me a brief kind of explanation on your background and how you
Yeah.
decided to go into lending.
Yeah. So I've got a finance degree, and my dad was in new home sales for 35 years,
Oh,
and graduated college and worked with one of the mortgage companies that he was partnered with. That was back in 2003, and I've been trapped for 17 years ever since. So absolutely love it. Like I said, grew up in a new home sales family. Always loved finance, loved the finance side of it. So becoming a in-house lender, preferred lender for a new home builder just seemed like the natural fit, and I just love it.
that's awesome, man. I mean, I know I've known you for a while. You seem to always deliver on what you've set out to do, and your reputation precedes you, especially within this company at Coventry Home. So I appreciate everything that you've done, and honestly, I'm glad that you're part of our team and helping us out. So
Yeah.
I want to dive into some of these questions, man. I definitely have some insight and different types of knowledge I want to kind of provide to some people. So talk to me about what's going on out there. It's kind of a crazy world. So, but more specifically, what are you seeing in terms of rates? How's this kind of messing with some maybe buyer programs that are out there to kind of help people move into their house? Do you have any comments on that?
Yeah, absolutely. So first thing we'll talk about is interest rates. On any given year, the mortgage industry is going to do about $6 trillion in fundings. And when the coronavirus really started to spread, there was major concern across the global economy as to what kind of impact this was going to have. And what that did was that caused mortgage interest rates to drop. And so, like I said, you're looking at a $6 trillion a year turnover in mortgages on every 12 months. And in the month of February, in about a 30-day period of time, because rates had dropped so much, we saw the mortgage industry do $2 trillion of loans. So we did a third of the business in a twelfth of the time. And what happened was a lot of lenders had all of these locks that they took in, and they didn't have any more money left to lend out because they had locked so many loans that we saw interest rates drop and then unexpectedly just jump back up. I mean, there was a period of time where we were locking rates at 3.75, dropped down to 3.25, and then a week later they were at 5%. And the market wasn't saying, hey, we're at 5% interest rates. It was the lenders saying, we don't have any more money to lend. We're going to raise our rates to 5% to slow everything down because we have a liquidity problem. So since that time, what we've seen is the turnover happen. We've seen the locked loans for the refinances close. The loans that were currently being serviced have been paid back off. The money's come back into the system, and we've seen interest rates come down. That took a 45 to 60-day window for all of that to occur. During that time, the coronavirus did continue to spread and global economies continued to get worse. So what happened then was the Fed stepped up and they said, hey, we want to keep the mortgage industry moving again. We want to keep liquidity moving and keep loans funding. So the Fed has injected a ton of money into the mortgage-backed security market. And what that's done is that's given us low interest rates for the time being. And the Fed has basically said, we're going to keep doing this as long as we need to because we want to keep mortgage rates low. We want to keep liquidity high. We want to keep loans funding. So what we're looking at on interest rates is the lowest I've ever seen. Like I said, I started in this industry in 2003, 17 years ago, and we're locking 15-year fixed rates at 2.5%. We're locking 30-year fixed rates at 3.1, 3.5. And when you look at what that can do as far as affordability on a home buyer, it takes a buyer who 6 months ago maybe only qualified for a $350,000 house at a 4% interest rate. They can now qualify for an extra $100,000 at a 3.5% interest rate because the money's cheaper. And so as far as new home sales go, this has actually been a good thing for new home sales because it improves and increases the affordability of the houses.
Right.
The rate market has been excellent. And so what we're hearing for forecasts is that rates are going to continue to stay low through the remainder of the year. There's some uncertainty about what's going to happen in the future with the economic situation. The Fed has stepped up and said, we're going to keep pumping money into mortgage-backed securities to keep rates low. Where I see that as a benefit to new home sales is when you look at build times and you look at somebody buying a house that they're going to build from start to finish, you know, what do you think an average build time would be? 6, 7, 8 months?
I would say around 7 to 9 for sure, depending on the area.
So what's nice about what's happening is you look at a 7 to 9 month build time, and you look at a forecast of interest rates and the Fed's commitment to keep buying mortgage-backed securities. There's a lot of stability in buying today and closing 7, 8, 9 months from now with interest rates, because we won't actually lock your rate in until 2, 3, 4 weeks prior to closing. So you float with the market during construction, and you know we've got these federal commitments to keep the mortgage-backed security market moving. As far as my 17 years in new home sales industry and finance, I've never seen anything where they're offering this much stability with interest rates.
It's honestly pretty incredible, man. Like, seeing where things are at, giving the people really the affordability to get into a house. I mean, one, I felt like it was pretty easy even before all this kind of started up, even with higher interest rates. But
Hmm.
just kind of really understanding those numbers and what they directly translate to. I think when you explain it to a buyer, it's just mind-boggling. Like they're like, oh, I come in at a $450,000 price point, expecting this payment, and they're like, assuming it's maybe on a 4.5 interest rate, and then they realize they're at 3, and it's just like it's a world of difference. And I guess that's actually a good segue into maybe the next question, on really kind of what the restrictions really are doing now for some of these buyers. If what are some things that I guess you've heard, or that you're aware of now that obviously interest rates are great, best time to buy right now, I believe. But in terms of the restrictions, there's a lot of rumors out there that credit wise it may lessen the qualification for some people, or might tighten up the restrictions on what those loans are going to be able to be approved for. So what are some new restrictions that you're seeing, or maybe some openings that new buyers potentially can take advantage of, or need to be aware of?
Yeah. So as far as restrictions go, we're primarily seeing those on government loans. So government loans going to be like an FHA or a VA loan. And in the San Antonio market, we do a lot of VA loans. And
Yeah.
so some of the restrictions that we've seen there is mostly tied to credit scores. In the past, we've been able to do a VA loan with 100% financing, between your credits and credits we can give, we can cover all their closing costs. Let's say the buyer gives you a few $1,000s for deposits, upfront a contract. We've had several buyers go to closing and get that money back, get their deposits back. They're truly zero out of pocket to get into the house. We're starting to see some of that tighten up where we cannot give the buyers credits anymore. We're seeing credit score requirements tighten up where, we used to be able to do that down to a 600, a 620. We're really wanting to see the buyers at a 640 or a 680 right now. You're seeing different pricing thresholds. If
Right.
they're below a 620, it's a case by case deal on, what's happened to the credit score. Is there a way to get the credit score up? What was the big picture of the loan? How come, we're at a 620 score? Was there a medical collection that hit that, should not be having the impact it is on the credit report? Or is there something else that occurred? So we're going to take it case by case on that. FHA is kind of the same thing. So we used to just go off of whatever our automated underwriter told us for findings and approvability. But now all of the lenders are looking at these and they're saying, there's a 640 threshold, there's a 680 threshold. If you're below the 680, there might be some overlays. And what an overlay is additional documentation we have to gather to provide strength to the loan. So an example being, we could have a 700 credit score on a VA loan and do 100% financing and be fine. We have a 640 credit score and do 100% financing, but now we have to show that buyer has 3 months of reserves in the bank. And so if the mortgage payment is $3,000 a month, we would have to show the buyer has $9,000 of money in the bank after closing. And
That's
so
a lot.
those are what typical overlays look like that we haven't really had those.
I was going to say, like, I mean, that seems like it's an incredible difference between, you know, prior to 2009, 2008, where I feel like everybody might have been able to get a loan to. We have really tightened it up. I mean, even since I've been in the industry, I mean, it's completely different. And I think this
Hmm.
coronavirus has kind of given us a little scare into realizing that maybe we do need to loosen up some ends and, kind of tighten it up just to really be cautious and, hopefully not prep us into a position where we might have another, real estate fall of some sort. So in some ways, it's good to see that restriction, but I think
Yeah.
there definitely needs to be more insight to buyers and realization to know that those kind of things exist, and those may be obstacles to account for. You know, and kind of with that, you know, it transitions to maybe another question we were going to talk about, which, you know, we have different programs out there. There's different restrictions. One thing I'm always getting is, you know, talk to me about, you know, what your max payment is or what your max price point is, you know,
Hmm.
and we need to be around 450. It's totally fine. But let me ask you this, you know, are you guys going off the price point? Or are you guys more concerned about your monthly budget? And when it starts getting to that subject, a lot of them are kind of not really understanding, you know, what the monthly budget realistically will look like, especially with these interest rates kind of fluctuating as much as they are, you
Hmm.
know. And so I kind of try diving into different programs regarding PMI.
Hmm.
You know, if you could dive into what that is real quick, but then also maybe some different ways that people aren't really aware of that, you know, you could get a little creative on how to remove it. Obviously, the 20% rule is kind of what a lot of people know about. So if you could jump into that, that would be awesome.
Absolutely. So, you know, a couple of topics there is some people come in and they say, hey, we want to be at the 450 price point. And, you know, when I hear that, my first question is where did 450 come from? What is it about the 450 price point that's important to you? And, you know, what it boils down to is really three things. What is your cash out of pocket target or goal? Meaning, how much do you have available to come out of pocket to get into the house? Is it a percentage of the house? You know, 10% of 450 is 45,000. Maybe the buyer says, I've got 32,000. You know, the next thing we're going to look at is monthly payments. What are your targets for monthly payments? Do you want to be at 2,500, 3,000? What, you know, really where is your target there? And then the last thing is how long do you plan on being in the house? And that has a lot of importance, especially when we start talking about less than 20% down with mortgage insurance. So, mortgage insurance is an insurance policy that is tied to the loan that protects the lender in the event that the borrower goes into default. And so that's an insurance policy that the homeowner, the borrower, has to pay to protect the lender. A lot of buyers don't like having that on the monthly payment. It increases their monthly outflow. And so they always ask, how do we get around that? You know, back in the day, we used to do first and second mortgages like an 80-10-10 for a 10% down loan. You do it 80% first, 10% second, or an 80-15-5. Rates on the second mortgages are a lot higher than what you'll see on the first mortgage. So it's not always the best thing to do. And then we look at mortgage insurance. Most people view mortgage insurance as a monthly requirement. We actually have an opportunity to prepay mortgage insurance upfront at closing. And the benefit to that is if you're over 700 and even more so over 740, the upfront cost of mortgage insurance, when you do the math on, hey, if I spend a couple thousand out of pocket at closing versus a couple $100s per month every month until it goes away, where's my break even period? When we start doing the math on upfront PMI versus monthly PMI, you're going to see break even periods around the 3-year window. And that's where we start looking at a loan where maybe somebody wants to put 10% down, and we look at the monthly mortgage insurance and it's, you know, it's adding a couple $100 to their payment. Well, maybe we do 8% down and we take that 2% and the other 2% that you have access to, and we buy out the mortgage insurance that's going to give you, you know, it's going to pay itself off in 3 years. And then maybe we do an interest rate buy down that you're going to save interest on for the life of the loan. And
Right.
so when we start talking to your customers, it's really, what do you have access to for cash out of pocket? Because that $450,000 target buyer might say, you know, I've got $90,000 that I want to put down and I want to do 20% down. And I can't tell you how many times we've done this. We've presented an option where they do 15% down. So they
Yeah.
keep 5% in their pocket. It's $22,000 they keep in their pocket. We prepay mortgage insurance, which is a few $1,000s at closing. We'll do a little bit of an interest rate buy down, and they can almost have the exact same payment as they would on the 20% down loan. Maybe it's a little bit higher, but they end up keeping 15, 17, $18,000 in their pocket after closing. And the monthly payment difference versus 20% down is negligible. It's so small. And it gives the buyers a nest egg. It gives them those reserves. It gives them money to, you know, customize the house however they want after the fact, the furniture, the TVs, you know, any other accessories that they want. And when they really see that we can move things around and get away from a 20% down payment to a 15 or 10, get rid of the mortgage insurance, buy down the interest rate, it saves them thousands over the life of the loan.
It's huge. I mean, that is probably one of my number one closing techniques is really kind of diving into those numbers because if you understand the financials, I mean, it kind of really opens the eyes of buyers. Even some realtors are still kind of not really understanding this, you know, and it's something that took me a while to can even get a grasp on. But I mean, like for example, I mean, the rule of thumb I've always been aware of and kind of heard of is like for every 10,000 you add into, a 30-year note, it comes out to about 60-80 bucks. And I feel as though from what I've seen, typically like an average PMI or MI that you're going to be receiving is anywhere between like 200 to 250. I mean, even on like a, 200, I mean, you're saving what, like, you know, 25,000 roughly, off the price if you're able to remove that. And again, you save yourself so much pocket money. I mean, you can put that towards furniture, you can put it towards buying down the interest rate. So many things that collectively can not only save you money, but keep additional liquidity within that account. And it's a huge thing. So yeah, I'm really happy that you're able to kind of go into that and help kind of provide further insight. I mean, I think that's an incredibly important topic for a lot of people to understand their affordability.
And
Last
most people don't know it's available. So I'm so happy you're bringing it up. I have a customer that we're going to close next Friday.
Yeah.
He wanted 20% down. His wife works in the salon business, and she's been out of work the past 60 days. And so he and I started talking about different loan options, and he's like, "Well, I really don't want the PMI, but I'm worried about putting 20% down." And I
Right.
said, "Well, let me show you this option." So I showed him 15% down. We did upfront mortgage insurance, which cost about $1,500 at closing. We did a little bit of an interest rate buy down. We took him from 3.6 to 3.2, and he's keeping an extra $13,000 in his pocket, and his monthly payment went up like $40 from
Jeez.
that extra. And when he looked at it, he said, "I had no idea we could even do this." And so
Yeah.
it's truly using finance as a tool. How do we use this to make your overall financial budget work best for you?
And I was just going to ask to that point too. Typically I've seen, like I was mentioning, like the PMI go between 200 to 250. The difference between like a 10% with a PMI buyout versus like maybe doing 20% down. I mean, I feel like the monthly isn't really that much of a difference. I mean, from
Mhm.
what I know, I feel like it's like 60, 80 bucks, maybe 100 at the most. Is that kind of accurate in that?
Yeah, I mean, it just depends on the loan amount, the purchase price, but what I will tell you is when you start looking at, can I keep an extra 5% in my pocket versus putting it down on the house on a $500,000 house? If I keep an extra $25,000 in my pocket, buy out the PMI, maybe do a little rate buy down. So at the end of the day, you're keeping $20,000 to $21,000 in your pocket, and your payment goes up $100. Are you willing to spend an extra $100 per month on your monthly payment to keep $20,000 to $21,000 in the bank after
Exactly.
closing? Those are the options we're going to present to you, and those are your choices you get to make.
And honestly, this is a huge reason why, one, I've been incredibly impressed with you, and then also the additional insight that you're able to provide. Because, I mean, I know I definitely harp on that message, but to have you kind of reiterate it as my loan officer and somebody that is incredibly aware of what's going on within the finance industry, it helps tremendously. So I hope that this message is going to help anyone and everybody else kind of thinking about, what the monthly budget and how important that should be versus the total overall price.
Absolutely.
Additional, really kind of knowledge to take home. I'll end you with in the call with this one question. Kind of wrapping things up is, we kind of know where things are at, and it's so hard to kind of predict where things can potentially go, especially with you have the upcoming election coming up. You're going to have what kind of resolution comes from the coronavirus. What do you kind of predict, if any sort of prediction may come up from what you see going forward, and how the market may sustain itself or kind of fluctuate even further?
hmm So, I won't make a prediction, but I'll regurgitate a lot of the other predictions I've heard. And some of the things that we're hearing is that we're going to see interest rates stay low through the summer of 2021. Some people are saying that we haven't seen the lowest of rates yet to come. We've heard people say that rates could be in the mid to high twos for a 30-year fixed, and that's just absolutely unprecedented. You think about a 2.5 to 2.8 interest rate for 30 years. I mean, talk about housing affordability go up. That's tremendous. When you think about rates staying that low, there's a lot of turmoil in the economy right now. There's a lot of people that have been laid off. There's a lot of people that have been furloughed, but there's also a lot of people still employed. And there's a lot of people that still are making money and have money in the bank. And those people are really going to be able to take advantage of what's happening right now on the sales market, new home sales market, on the interest rate market, because rates are just crazy low. As far as mortgage programs, we saw a pretty extreme pullback on qualifying for government programs. Haven't really seen that much in change for conventional loans. And since that initial pullback, March 15th, March 20th, when the fear took over, we were having liquidity issues. Everybody's saying, okay, people are getting laid off. What program guidelines are going to change? We've already started to see some of that loosen up. So, a lot of it has to do with, the states are now reopening. People are getting back out there. What's going to happen? Is there going to be a second wave to this virus? That could have a bigger impact on the economy. But as far as the specific mortgage industry, the bright skies ahead. I know a lot of people are going through a lot of hard times right now. Those of us who are in the mortgage industry and have been through down cycles, 2007, 8, 9, it shut a lot of people out of business. My phone's ringing just as much now as it ever has. And so, I think there's some good opportunities for people who are positioned to take advantage of these new home sales and these low interest rates.
That's awesome. Hey, Brad, I appreciate everything you've told me today.
Yeah.
Appreciate giving everybody the insight that you have. And it's been tremendous help. I hope everyone was able to take away a couple pieces of information from this. I know I even learned a couple things and really just kind of understanding the market even further. If you want to reach Brad, Brad is with FC Lending. If you had contact info, go ahead and send it to me. I'll provide it in the link below. That way we'll hopefully get a couple additional people that may have some questions, get those answered for y'all. But thank you so much for joining me. And we'll be in touch, Brad.
Thanks, John. Let's do it again soon.
Sounds good. Take care.